Hello, and welcome back to CMD Oral Space online lessons. Right, this is the master class for Candlestick Patterns. So we have done a number of them. We have about 9 episodes so far. So this will be the 10th episode, and we are on a topic now, market structure. Right. So if this is your first time, we recommend that you go back and read. In fact, watch the previous videos, like, and then subscribe to our page. And this is a master class, once again, for the intermediate Forex traders. We have the basic one, as in for the beginners, and then we have the advanced one, right? Now, for the record, the main aim of this class or playlist is for the trader to be able to do technical analysis on their own, right? It's better you do this analysis on your own so that you have the convenience time for trading and making money profitably at your own pace, right? So without further ado, you treat market structure. Now, when you talk of market structure, basically from the layman perspective or from the Tyro point of view, it's about the price action, as in the flow of the markets, right? The upward, the downward, the sideways movement of the market. So basically, when you talk about the market structure, it's of 4 types. I think we have touched on them on the uptrend and the downtrend, right? And then we talk about the ranging markets. And then the 4th one is the choppy markets. And then the choppy markets, I said, it's better, or to be in your best interest, to stay away from the choppy markets, right? So we would do more on this. Now, for the purposes of not getting you bored with a long hours of the video, we will still stick to 30 minutes of for what? The 30 minutes for each episode. So for this market structure, we might use 2 parts, maybe part 1 and part 2. It will depend on what we are supposed to watch at the time on our side, right? So the market structure. Now, one of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action. So the price action is basically the flow of the market, moving up, down, sideways, and all of that. Yes, using the charts to do your analysis. That's the price action strategies in the right market condition. You are not going to trade all the markets the same way. You will need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior, how the markets behave, how they move, how the buyers and sellers react at a particular level, whether at the support level, the resistance level, during the news or whatever, right? So that is what is called or meant by the market structure, right? So it says something like we are not going to trade all what's the market in the same way, right? It means that at some point you have to exit the market. At some point we have to enter the market, and then there are times that you have to know when to actually wait, right? You don't have to be trading all the time. You can't be trading all the time, right? So we look at for higher probability setups, and then we can trade. So that is what it means. Now, and if you can master this skill, when you open your chart, you will be able to answer these important questions. We're going to look at the questions. Now, what the crowds are doing. What it means is that what are the market players doing? The market players are the buyers and sellers. That is what we are doing. Okay, when you mean what are they doing, it means are they buying, are they selling? Or are they at some point whereby the indecision in the market is very high? Is that at the point that we are now? That is it. Who is in control of the market? right? Who is in the control of the market? Is it the buyers or the sellers, right? What is the right time and place to enter or to exit the market? And when you need to stay away. So like I said earlier, if you listen to me, whatever my introduction to every topic, if you listen to that, I think you are good to go, because whatever we have to read is what I have summarized. So that is it. Now, through your price action analysis, you will experience 3 types of markets. We are talking about the trending markets. The trending markets consist of the uptrend and then the low trend, the downtrend. Sorry. Now, ranging markets, like we said, right? The consolidating, another name for that. Then you have the choppy market. Sorry, that's what you have to avoid all the time. Now, in this chapter, you will learn how to identify every market and how to trade it. So one of the market structure is the trending markets. The trending markets is the uptrend and then the downtrend. Now, trending markets are simply characterized by a repeating pattern of higher highs, and higher low in an uptrending what market, right? And a lower high and lower low in downtrending markets. Now, there's this term, higher highs and lower low, right? So for uptrend, an upward trend, we have the higher highs and then higher lows. Sorry, we have higher highs and higher lows. For the uptrend market, that's what we have, right? Higher highs and higher lows. Higher highs and higher lows for an uptrend, meaning what? Market. Now, let me draw your attention to this. When I was an amateur, right, I was a beginner in the field of forex trading. This term, as basic as they may seem, was very confusing to me, right? And I, for instance, I in person do not like to learn in abstract. What I mean is, as in you just learn or just learn a thing without having an appropriate understanding of whatever it is, right? We just learn because we just read them because we just have to understand whatever is going on, right? So that is very bad. Excuse me. Sorry, give me a minute. Don't worry, ignore whatever is going on. So we do, I learned to be able to what? Teach, right? I learned to be able to teach. I don't learn because I'm just learning for myself or whereby for examination or any test, I just pour them down, I write them down, and then I leave, I go my way. I don't learn that way. I learn to understand so that I can teach other people. That is my main aim, right? So whenever I learn any new thing, no matter how difficult, no matter how hard the thing it is, I try to find a way to make the thing very lucid, right? Pellucid for me to understand in my own way. So if I understand that way, then examination or whatever, I can actually write something down. So this is how I learn, right? So I know you may have an idea if maybe there are some people that have already learned about this market structure already, right? If you're one of them, please, you can skip this video and then allow the amateur, the new people, or in fact, the intermediate students to actually focus on this, right? So I'll find a way to explain things to you. So the higher highs and lower low. So in an uptrend, they are only found in what? In an upper trend, right? In an uptrend, I should say, right? So in general, if a market is moving up, it doesn't move up in a straight line. It doesn't move that way, right? It starts from somewhere, right? The down way, and then move up like this, come down a bit, go up, comes down and go up, comes and go up. So if you realize, you can actually see that there is a constant horizontal line, right? Not a horizontal line, at least you can even slant the line, right? They moved up in that sense, upward, a slow, a gradual upward movement. They move that way, right? So if you realize along this first line that I've drawn, the first one, and then this is the second one. The first line, we realize that at any point here, you see we have highs here, higher points, right? Take only that line, that slanted line, that steep line. We have these points moving in that upward sense, right? So realize that this second point is higher than this, right? This third point is also higher than this, right? And then this point is also higher than this. So when you look, if you compare the top lines, they are all moving upward, right? So they are on a higher level. Then before you come to the down points, even though they are all at when you compare them to the top lines or the top points, these points are low, at a lower point. But even among themselves, the points beneath them, along, or in fact, between them, we have some points being higher than the others. For instance, this one is higher than this, even though they are all at the lower level. This is higher than this, and this is higher than that. So don't worry, we have a picture of that. Whatever I'm saying, then you understand it better, right? So I'm going to show you a picture of that. Now, so this is an uptrend, right? So you can realize that in general, this is actually moving towards upward. This is an upward trend, like an uptrend. This is an uptrend. Because in general, even though it moves up and comes down, it moves up and comes down, it moves up and comes down. Generally, there is a what? An upward movement. There is an upward movement. So that is it. So this is what I meant earlier. So with the top lines or the top points, right? The top point that we see, the HH. The HH means higher high, higher high, higher high, higher highs. This is a higher high, 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 this is a higher high. So what it means is that they are all at the top. They are all higher than the lines or the points beneath them, right? So because the movement moves up, moves down, moves up, moves down, moves up, and moves down. So even if you pick one reference point at the top, this is higher than this, and at the same time higher than this, right? It's higher than this point. Let's assume there's a reference point here. This is where it started, the movement actually started. So this point is higher than this. At the same time, it's higher than this, right? If you move to this point again, this point is higher than this, even higher than this, and higher than this, right? If you move to this point again, this is higher than this, higher than this, and higher than this. Now, so even when you look among the top points, the top references, right? The top references, let's say, reference 1, reference 2, reference 3, reference 4, and 5. Even among them, this is higher than this. They are all at the top level. Means the first H, I consider the first H to mean that they are on the higher level, right? So that's what it stands for, the first H. That's the higher. They are all on the higher level. So all of them, you see the first letter to be H, H, H. They are all on the higher level. Now, and then the second H, I use it to mean that even though this and this, they are all on the same higher level, yet this one, this point 2, is actually higher than this. So I use that point, I use that analogy for me to understand it better, right? Like I'm going to say it again. The first H among the top line, the first H, in fact, among the first H among the top line, the top slanted line is what? It means that they are all on the higher level. Now, the second H, I take it to mean that even though they are on the same level, at the higher level, yet one is higher than the other. One is higher than the previous one. So this reference 1 and reference 2, they are all HH, yet the second H means that this is actually higher than this. So higher high, higher high. We are moving in the higher level, right? And then when I come to this one, the top down, the lower slanted line, right? Now, they are all moving in what? In the high level. That's what it means for the first H, like I said. They are all moving higher. One is higher, one is higher. They are all moving in the higher levels, right? But now, when we come back we need to explain for the second letter, that's the L's, realize that now, taking this and this, even these 2 points, reference 1, let's say reference I, and then reference II, this is higher than this, right? So you mean that this is actually lower than this, right? Even though they are moving in that higher sense, yet this HL is lower than this one, as in comparison. In the same way, this is also lower than this, and this is also lower than this, right? I hope you use this. You can actually use this analogy to understand it better. The easier that would be convenient, right? So with time, if you have a better understanding, a better way of understanding it, I think that one will be okay, right? So when you take the higher, the uptrend, right, is the movement is generally in the upward sense. They are moving in the higher sense. So the same thing that I've said here will be the opposite for a downtrend. So that is what I mean. Hold on a minute. So we are going to control forward. So we are going to read what it is. So as you can see in the example above, the market is making a series of higher highs and lower lows, which indicates that the market is uptrending. You don't need to indicate, you don't need indicators. You decide if this is bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. So let's look at another example. So this is a downtrend, right? A downtrend market. So that one is just the opposite of whatever we did. So here you start from here and then move it up, down sense. So that is it. No, wait, let me have a better drawing of this. I think this is not better. Okay, let's do this way. So that is it. So if you take an upper line, slanted horizontal line, slanted line, then you take the lower one, right? So move it in that sense, here, down, up, and down, right? So now, let me try and then explain this one, even though I've explained that with ease. Let's see if you can have a better understanding here, right? In fact, with the first explanation that I gave you there and the uptrend, that would be better, right? So we have the LH, right? So even though the market is generally, the first L means that the market is moving down, moving lower, right? That's the first L that I use it to make me understand it better or explain better. So the first L means what? The market is moving down, it's moving lower. Now, then the second letter, which is the HH, even though they are all moving downwards, there are some which is higher than the other. They are all moving, but there are some, or with comparison to 2 points, one is higher than the other, right? So that is it. So this LH, the second H, is higher than this, right? Now this second H is also higher than this. This second H letter is also higher than this point compared to this point. So they move in that way. And then the first L here also means that we are the lower slanted line, right? Lower slanted line. So we are lower slanted line. Then the second L in this combination means that one is also lower than the other, one is also lower than the other. So that is as simple as it is. So just try and then, the important thing is the visual representation of that. When you see a market, you should be able to understand it in that sense. So that is it. Now, the example above shows us a bearish market. As you can see, there are a series of higher lows and lower low, which indicate an obvious downtrend. The trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing a series of higher highs and higher low, it is simply an uptrend, right? A higher high and higher low is simply an uptrend market. Conversely, if it is making series of lower highs and lower low, it is obviously a downtrend market. According to statistics, trends are estimated to occur 30% of the time. So let's say the market, all the movements make up 100%. And then we are saying that for them, according to statistics, trends are estimated to occur 30% of the time, right? So that means it's a good percentage that you can actually use this as your strategy and only trade trending markets, right? Either upward or downwards. You can trade that, and then 30% of the time, this is how the market moves. So it's a good percentage that you can actually make profit from that. So while they are in motion, you've got to know how to trade, how to take advantage of them. So that is it. Now, to determine whether a market is trending or not, we have to use bigger time frames, such as the 4H. The H means hour. 4-hour time frame. That's what we have. We have a number of time frames, TFs, right? So the H means hour. We have M, meaning minutes. And then we have MN, meaning month. We have Y, meaning years, right? So that is it. We even have S, meaning seconds. So that is what it is. So when we talk of time frame or top-down analysis, we are talking about the time that you trade in, right? And then we are saying that to determine whether a market is trending or not, we have to use bigger time frames, such as the 4-hour, the daily, or the weekly time frame. Never try to use smaller time frames to determine the market structure, right? Meaning that if you use a smaller time frames to do your analysis, because on the lower time frames, there's something we call noise, meaning there are false signals that if you don't take care, you are going to lose your capital, right? So if you use a lower time frame to do your analysis and trade them within a smallest time or maybe the shortest time possible, you realize that the market is even moving in your opposite direction and you're going to lose. So for a good technical analysis, your analysis should actually be done in top-down analysis. So the top-down analysis, we will also we will look at this again. Top-down analysis means you study or you do your analysis based on higher time frames, right? For instance, if you want to actually trade the 1-hour time frame, your analysis should start from the daily one, and then come to the 4-hour, and then before you come down to the 1 hour actually. So you do this analysis, and when all these 3 different time frames actually coincide, or there is a one direction among these 3, you can actually take your trade. Either you're going to buy or you're going to sell. So that is what it means by top-down analysis or a higher time frame. So that is we have a look at this again. So that is it. Now let's move to how to trade trending markets, right? So we have a way of trading the trending markets. Like I said, you can't just enter into the market because you see the market is generally moving upward or generally moving downwards. No, before you can actually take a decision, you have to take into factors some things, right? Which we call the confluence. So that's what you're going to look at. Now, if you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for buying opportunities, right? So what it means is that if the market, you can only trade in general, you can only buy the market when the market is what, moving upward. And then you can sell when the market is what, moving downward. So uptrend, you buy, and downtrend, you sell. That's the general rule, right? So you will still learn more about these things. Now, because you have to trade with the trend, and if the market is bearish, you have to look for a selling opportunity, right? But the question is, what is the right time to enter a trending market? Trending markets are characterized by two important moves. The first move is called impulsive move, and the second one is called the retracement move. The retracement movement, right? So let me even have a sketch here, right? Uptrend starts this way. They move up, down, move up, down, move up, down, move up, down. That is the general movement for an uptrend, right? And then we are saying that the movements, the first move in this way is called the impulsive, IM, impulsive movement, right? Impulsive. So the market moves impulsively, then it will draw back, it will retrace. So that retracement is called what? The retracement movement, right? It moves up and moves down, right? So that is it. So R. So I and R. It moves, withdraws, it moves, withdraws back, it moves, withdraws back. So that is the movement, right? So you have to look at these things before you can actually buy. So that is because the market is moving generally upward. You can't just enter anywhere at all. You have to enter at a specific point. So a place that you can actually enter buy, you enter is this point. One, this can be one, this point can be one, the buying point. These are the buying points, right? Because when it moves here, if you are buying, if you enter here, the market is going to move up. So you can actually take your profit here. If you are someone that you don't want to stay long in the market, you can enter here, exit here, right? Then you can come here, enter here, exit here, right? Enter here, you exit here. You enter here, you exit here. So that is the general thing that is done when it comes to buying the bullish market. So that is it. So let's look at this. This is a perfect example, right? It moves this way, the market moves this way, right? It 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 moves this way. So realize that now this movement, the first move is the impulsive move. When it comes back, it's retracing. So retracement movement. It moves up, impulsive move, it retraces. Impulsive move, it retraces. Impulsive move, it retraces. So that is what we were talking about. This is a graphical representation, as simple as ABC. Now, as you can see, the market is making higher highs and lower lows, which indicates a bullish market. If you can see this market, you will think of buying. That's what it is. You can think of buying. It did not say you should buy all the time. You just say that it's a probability, as in the probability that when you do that, you are going to be profitable. But as you can see, the market is making two different moves. The first move is an impulsive move, and the second one is a pullback or retracement move, right? So that we are also adding more to the terms. So the impulsive move is also called pullback. Now, this term is rather common among traders, that the impulsive move, the name, the term. So you rather use the pullback often than the impulsive. Then the retracement too. Another name for the retracement is the corrective move. Now, with these two, we often use the word retracement yields more than the corrective one. They are the same thing. So that is it. Now, professional traders understand how trending markets move. They always buy at the beginning, right? Like I said, we buy at the beginning of impulsive moves. We buy at the beginning of impulsive move and take profits at the end of what? That. Take profit at the end of that impulsive move. Let's go back here. You buy here, then what? You take your profits at the end of that impulsive, the beginning and the end, right? And if you want to do another buy, you can buy here at the beginning of that impulsive move. This is another impulsive move. You buy here and exit here. So that is what we are talking about. So you should do that. Some may also ask that, okay, now among the impulsive move and then, in fact, between the impulsive move and the corrective move, you can actually do what? Sell, right? I won't argue with that, but my advice, I wouldn't recommend that you sell in an uptrend, in an uptrend, right? I wouldn't recommend that you sell in an uptrend because that is not going to be beneficial, right? So it's better, the general rule is that you buy in an uptrend and then you sell in a downtrend, right? So if you buy at the beginning of an impulsive one, and then what you sell, or in fact you exit. I'm not going to use the word sell. You might get confused. So you buy at the beginning of the impulsive, and then what do? You exit, you take your profit, and you leave. Then if you still want to go back to the market and then buy, you have to wait for this to actually get to a level like this form. We have a way of what? Ascertaining that, a way of identifying or determining that with the help of some indicator called Fibonacci retracement, whatever, right? So we get there. You use it to actually know where is going to be the end of a retracement, so that you can actually do what? You can actually buy. So that is what it is. So that is it. So we will get there. Now, we are here. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move. Wait, let me take it again. Now, if you are aware of how trending market moves, you will know that the best place to buy is at the beginning of an impulsive move. So there should be actually what? A full stop here. Now, traders who buy an uptrend market at the beginning of a retracement, they got caught up, right? Good. They got caught up by professional traders, and they don't understand why the market hits their stop loss before moving in the predicted direction. So what it means is that if you want to actually buy an uptrend, you should buy it at the beginning of an impulsive move, right? You should do that at the beginning of it. Now, if you miss that move, the beginning, the onset of that move, if you miss it, don't force yourself by joining that move, because there's a higher probability that you will lose, right? You will lose because maybe the time you enter, it will be too late for you to actually make the profit. And then many a time when you buy in the middle of it, in the middle, some way just above the beginning of it, instead of you exiting, you might think your profit is too small, right? Your target has not been hit. So what you have to do, what you do is to wait more. So waiting too much can actually be detrimental to your trading capital. So that is what it means. So if you miss the beginning of an impulsive move, just have to let it be and then wait for the next one. So that is what it's trying to say here. Right. So we have a look at the bearish one. Let's see. So in the same way, it's just as simple as that. So generally, in a downtrend, right? In a downtrend, you sell. In the downtrend, you sell the market. And then the selling, you just don't enter by selling. What do? You actually want to what? Sell at the beginning of what? The impulsive move. It's the same as the other side. If you want to sell, if you want to buy, you buy at the beginning of impulsive move. Now, in the downtrend too, if you want to sell, you do that at the beginning of what? The impulsive move. If you sell here, right, this could be your what? Your entry. Your SL can be anywhere here, and then your TP doesn't take your profit, can be somewhere here, right? So that is it, can be here. So when you get to this level, you can actually leave the market, then wait for it to retrace, get to this point. If you want to enter again, you enter here, then we SL may be here, your TP can be here. So in that sense, the same thing, right? Just the opposite in the other what scenario. So that is what it means. So let's read what it means. The illustration above shows a downtrend market. As you can see, the market best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, if you try to sell in the retracement move, the retracement, when you say it's in the selling and this is it. So the retracement move is actually going to be like this. It's going back. So that is retracement. So if you sell here, you're going to lose because that time could be what? It's actually the time that the market is what? Moving up a bit. So that is, so you lose. Now we know how to identify downtrends and then uptrends, and how to differentiate between an impulsive move and a retracement move. This is very important for you as price action trader to know. But the most important question is how to identify the beginning of an impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement move. So it's very important to what? Be able to identify these moves. So generally, it means that a trader could actually what? Identify if the general market is an uptrend or a downtrend. Yet he may what? Lose in that market, even though after identifying that this market is what? In a downtrend or uptrend, the trader could actually still lose because they did not know when or where to actually what? Enter the trade, where their entry points should be, and their XLs and the TPs should be, right? So this profession or this lesson is in a sequential sense, in a sequential order. You identify the market if it's in an uptrend or downtrend. That one, from a layman perspective, you can actually see if the market is going up or coming down. You can actually identify that. Now, after identifying that, you have to know the pullback and then the retracement in that particular trend. After knowing that, you have to know where or when you can actually put your SLs and your TPs, right? And then enter the market, right? Now, you remember we did the patterns, right? So these patterns will actually help us. It's going to play like a confluence. Like I said something of that sort, a confluence. So you identify, so we are adding some factors. Whatever you have learned so far, you don't learn one thing and forget it and move to another thing. So we are what? Building up, building blocks. You know your patterns, you know your trend, you have to know your patterns. So where the patterns actually meet with your support and resistance, right? And with the help of the retracement and then the impulsive move, then you can actually enter the market. So make sure if you have forgotten about your candlestick patterns, please go back to the previous videos and do that. Else, don't continue with this video because you won't understand anything at all. So that is my advice. So don't continue until you have done the previous video, or if you have actually understood the previous videos, right? To predict the beginning of an impulsive move in the trending market, you have to master drawing support and resistance level. right? So what are support and resistance levels and how to trade them on our chart? This is what we will see in the next chapter, right? So this will be the end of this particular episode. So I recommend you go back and then do your candlestick patterns well. You learn them, and then you can come back to this very episode, right? So thank you very much for sticking with us. So please like our videos, subscribe. Then if there's any problem or anything that you don't understand, you can write to us, right? We also provide one-on-one private lessons, right? Still online. So you can contact us and then we'll get back to you. Thank you very much for watching this video. See you in the next chapter. Bye.